What if the dollar, the very foundation of global finance, suddenly lost its anchor? What happens when money itself can no longer be trusted? The 1970s was a decade when inflation spun out of control, wages collapsed under rising prices, and governments scrambled for answers. It was called the Great Inflation, a storm that reshaped the modern economy.
In the late 1960s, America was riding high. The post-war boom seemed unstoppable. Factories hummed, wages rose, and U.S. dollar was king. Under the Bretton Woods system, every dollar was tied to gold, promising stability. But beneath this apparent prosperity, cracks were forming. The Vietnam War drained resources. President Lyndon Johnson's Great Society programs expanded government spending. At the same time, foreign nations began demanding gold in exchange for their dollars. America's gold reserves thinned. By the early 1970s, President Richard Nixon made a shocking decision. He closed the gold window. The dollar was no longer backed by gold. Money became paper, floating freely on trust alone. At first it seemed manageable, but then came the oil shocks. In 1973, the OPEC oil embargo quadrupled oil prices almost overnight. Gas lines stretched for miles. Inflation, already simmering, exploded. By the late 1970s, Americans faced double-digit inflation year after year. A dollar in 1970 could barely buy half as much by 1980. Ordinary families felt the squeeze. Paychecks evaporated, savings shrank, mortgages became unbearable. For many, the promise of the American dream slipped away. The Federal Reserve struggled. Under Chairman Arthur Burns, it hesitated, raising rates, but not enough. Politicians feared slowing the economy more than stopping inflation, so prices kept climbing. Economists even invented a new word, stagflation. High inflation combined with stagnating growth and unemployment. It was a nightmare scenario, something textbooks had claimed was impossible. By the end of the decade, America was desperate. In 1979, Paul Volcker became Fed chairman. His approach was brutal. Raise interest rates high no matter the pain. Rates soared above 20%. Borrowing became crippling. Businesses failed. Unemployment rose. But slowly, painfully, inflation broke. By the mid-1980s, the dollar regained stability. The medicine had worked, but at a terrible cost. Why does this matter today? Because the patterns echo. Governments still borrow heavily. Central banks print money at historic levels. In 2020, trillions flooded into the economy to fight crisis. And once again, inflation returned, reminding us of the 1970s. History whispers a warning. Money untethered from discipline always drifts toward chaos. So what can we take away from the Great Inflation? First, money is only as strong as the trust behind it. Once trust cracks, collapse follows. Second, short-term political gains often worsen long-term financial pain. Leaders delayed hard choices in the 1970s, and people paid the price. Third, inflation is not just numbers on a chart, it is human suffering. Families watching their savings vanish, workers struggling to put food on the table. The Great Inflation of the 1970s was more than an economic event. It was a warning, written in the disappearing value of every dollar bill. And the question we face today is chilling. If money lost its anchor once, could it happen again?